Look, quick question. Why do so many people lose money in the stock market, even when the market itself is going up? Think about that. The market grows over time. But most individuals, they underperform. Or worse, they quit after losing money. That's not bad luck. It's the way they buy. And today, I'll show you 4 ways people approach stocks, starting with the one that destroys portfolios and ending with the strategy that quietly builds wealth for decades. My name is Henry, and I spend way too much time thinking about how people invest and why most of them get it wrong. If you're someone who wants to stay in the game long enough to actually win, hit subscribe, because this is less about getting rich fast and more about not going broke. 4. Trying to time the market. The dangerous illusion. Let's start with the worst one. Trying to guess. The perfect entry, the exact bottom, the ideal moment to sell. This is what most beginners do, and it feels logical. Buy low, sell high. Simple, right? Except nobody consistently does that. Even professionals struggle. Here's the problem. When prices drop, you hesitate. You wait. When prices rise, you feel like you're too late. So you end up doing the opposite of what works. Buying high, selling low. Not because you're irrational, but because you're human. 3. Random buying. Better, but still weak. Now, we move to something slightly better. You invest, but without a system. You just buy when you have extra cash. Follow the news. Maybe copy what others are doing. And yeah, this can work, because at least you're in the market. But here's the issue. There's no consistency, no structure, no clear strategy. So your results depend on emotions, timing, and randomness. And over time, that leads to unstable outcomes. 2. Dollar cost averaging, the SMART system. Now we get into something powerful. Dollar cost averaging, or DCA. This means you invest a fixed amount of money at regular intervals, no matter what the market is doing. Up, you invest. Down, you invest. Sideways, you invest. And here's why this works. When prices are high, you buy fewer shares. When prices are low, you buy more. So over time, your average cost balances out. You remove emotion. You remove timing. You replace it with consistency. And this is where it gets really interesting, because consistency is what keeps you in the game. 1. Buy and hold, plus reinvest, the wealth engine. This is the strategy that quietly creates wealth, and this is where everything comes together. You don't just buy stocks. You hold them long-term, ignore short-term noise, and reinvest dividends. Now here's the key idea. The real power of investing is not timing, it's compounding. When you reinvest dividends, your investments start generating returns on top of previous returns. And over time, that effect accelerates. At first, it's slow, almost invisible, but then it starts growing faster than your contributions. And eventually, your money is doing most of the work. So here's the real takeaway. The stock market doesn't reward guessing, reacting, or chasing trends. It rewards patience, consistency, and time.